Hello and welcome to our webinar organized by the project Mainstreaming Innovation. My name is Branka Dimitrijević and I'm also directing this project. Our project is a joint project of 9 Scottish universities and it supports collaboration between researchers and businesses in developing and testing innovations for low carbon infrastructure. The project is funded by Scottish Government. Before we start, just a few housekeeping points for this webinar. If there is a fire alarm, we will have to stop the webinar, and please do join us after the fire alarm. But if you cannot, then you will be able to watch a video recording of this webinar in a few days. There might also be some interruptions in connections, online connections. If that happens, please try to reconnect with the webinar. During the webinar, you will be able to ask questions at any time by using chat facility, but the questions will be answered after the presentation. The event will close at 2 o'clock, but you can ask questions anytime after we start with presentations and during the webinar. Before we continue with the webinar, I will just like to say a few words about the project itself. As you can see on the slide, it is related to integration of different types of low carbon infrastructures. We try to support and encourage identification of synergies between these low carbon infrastructures to try to achieve better efficiencies and savings. During the project, from the start, we have found out that there are many funding programs related to low carbon infrastructure, and we would like to assist two businesses to identify different types of funding programs, and with that aim, we have organized a series of webinars and events related to Scottish, UK, and European funding programs. So the first one in this series is organized in collaboration with GIB or Green Investment Bank. Our speaker today is Gregor Paterson-Jones. You can see him on the right part of the screen, and I would like to welcome Gregor. Hello, Gregor.
Hello, thank you.
To thank you for agreeing to speak at this webinar. Gregor is speaking from his office in London today. Gregor, you're welcome to start with your presentation now.
Thank you very much, Branka. So I'm Greg Paterson-Jones. I am the Managing Director of the sector Energy Efficiency at the Green Investment Bank. And I'd like to take you through a bit of history and background to the provenance of the Green Investment Bank, the types of things that we've been set up to invest in, and then look a little more definitively at the market for energy efficiency and where we see the opportunity and how we see our role in addressing the market failure. So taking a step into the background to the Green Investment Bank and what is ultimately pulling us in the direction of investing in these areas. First of all, the UK signed up to a number of fairly demanding environmental targets. By 2020, we have to reduce our greenhouse gas emissions or carbon dioxide equivalents by 34%. The proportion of renewable energy as part of the energy mix and the generation mix in the UK has to increase to up to 15% in total. And we've got to reduce biodegradable waste to landfill by a massive 65%. So these are fairly aggressive targets. And in order for that to happen in a short space of time, you obviously need the funding and the funding structures behind that to help it happen. So we estimate that in total, from all the sources of finance currently available in the market, that this will take an investment of approximately £200 billion, that's billion, of new investment. And obviously, levels are far short of this in the current market. So our mission as a bank, and this goes beyond the sectors that I'm directly involved in, this is our mission as it was set up, is to transition the UK to a greener economy and internally to create an enduring institution which addresses market failures and is commercially viable over the long term, investing in these areas. So we've been given by the UK Treasury £3.8 billion of funding, and we are targeting to commit this capital by March 2016. So obviously a fairly aggressive target. The one advantage that the Green Investment Bank has, in that it is being structured ab initio and it's being set up to address these market failures directly and not as a larger commercial institution, is that we've got the ability to invest anywhere along the capital structure in these projects. So we can invest both equity, mezzanine finance, we can asset finance assets, which results in reduction in emissions or reduction in energy usage or promotion of renewable energy. And we can also do bog standard project finance. So very flexible in terms of how we apply the money. Most important to note, though, is we've been set up to deal on commercial terms. So we don't provide donor funding, we don't provide grant funding, we provide commercial funding. And our commercial funding has to be additional. And what that means is that we are not allowed to compete with other lenders in the market, but where we see a lack of commercial lending in a particular area in the market, we are deemed to be additional to that. So we have to invest in a way that crowds in other capital. So ultimately, if you had to look at our task, it is to invest in the more difficult to invest areas using innovative structures, but with the result that other banks or financial institutions will follow us in investing. But we don't invest in terms which aren't commercially viable, both in the short and the long term. So 80% of our capital as an institution has been allocated to three sectors, and those sectors are energy efficiency, which is a sector which I oversee, and I'll go into the subsectors in that area in a moment. The second is offshore wind, and the third area is waste recycling and energy from waste. We do have what we call non-priority sectors, and some of those sectors are less developed from a technology point of view, so there'll be future funding opportunities for us, and some of them are nearer term, and we've already started investing in some of those areas. The first one is biofuels for transport, and we focused on second generation biofuels, so the technology there from an investability point of view is some way off. Biomass power, obviously there's a lot of that, both on the small and the larger scale going on, so that's something we can support immediately. Carbon capture and storage, again, early days in that market, but certain projects making significant strides. But right now, we don't have any investable opportunities in that area. Then marine energy, something which we expect to increasingly become part of the energy mix. But again, the technology is at a demonstration stage. And then lastly, renewable heat. And renewable heat is a focus for DEC. It's something that the government is very keen on promoting, and the renewable heat incentives show that there is a commitment to support that market, although the uptake has been fairly slow. But we do expect some activity there in the future. So we have a double bottom line, and that means we've got to be green and commercial. So when we look at a project, right from the start of doing due diligence and early review, we have to assess whether it'll make a difference from a green point of view. So we measure the green impact against 5 specific measures. Firstly, does it reduce greenhouse gas emissions? And generally those are carbon dioxide equivalents. Does it improve efficiency in the use of natural resources? Does it protect or enhance the natural environment? And does it protect or enhance the biodiversity or stop degradation of biodiversity? And does it promote general environmental sustainability? And within those parameters, most of our projects will tick 1 or 2 or even 3 boxes. Energy efficiency, just by nature, will automatically be green. The commercial side of things comes in what our state aid approval. We are a state-funded institution, so we have approvals to do certain things, and our approvals are not to compete with other financial institutions, but to be additional, as I said. So we are a for-profit institution. We have to develop a commercial return on any investment we make. We don't spend money, we invest money. We operate within those state aid rules, and again, our capital must be additional. So our investment strategy in each of the sectors, very broadly, before I go into the energy efficiency market in a little bit more detail. In the offshore wind, We work within the market to recycle and reuse capital that has been already committed to the sector. So what we'd like to do in the case that there are a limited number of developers in the market, obviously future projects are restricted by the cash position of those developers. So to the extent we can refinance the deals that have already been developed, that frees up extra capital to be invested in new projects in offshore wind. So we have the responsibility then to make offshore wind, pull it into the mainstream, and make it a more acceptable asset class. And we've had some success in some projects already in that area, and are moving in the very early stages to catalyzing the investment appetite at the construction stage, which is the more challenging stage in offshore wind. So on the waste recycling and energy from waste area, we allocate capital to small waste fund managers, and we've done that in the case of 2 sub-funds, which we have supported. And then we look at equity investment in smaller scale projects. The larger scale projects, generally, we fund on a debt basis. So the direct investment, the range of products we have, we've got a scope to innovate within that. So as I said, we can invest in the equity or the mezzanine or the senior debt in those waste projects. In the energy efficiency area, we are investing in developing the market in non-domestic energy efficiency. So the domestic side of energy efficiency is not something the bank, other than its initial investment in the Green Deal financing structure. But right now we only focus on non-domestic, so commercial and industrial. And we have an existing partnership with 2 fund managers on the energy efficiency project side, and the third one on energy centres in the NHS. And we are aiming to do a lot more direct, larger investment ticket sizes in a number of areas in the energy efficiency market, which I'll go through in a moment. So as I said, we have supported the Green Deal, although we're not directly involved in the managing of those funds. We embed green into the investment process right from the start, right through to the end. So we do an initial green impact assessment to see if it meets certain green hurdles, and that is part of our initial assessment and review of a particular project. Then throughout the project, when we structure the project from an investment and legal point of view, we put those green covenants and requirements as part of the legal documentation. Once the transaction has been completed, then we have an independent portfolio management team which manages the monitoring and reporting of those green outcomes. And there will always be consequences for non-compliance. So we embed those into our transaction and execution processes. So it obviously has to have a positive contribution and a positive green purpose, and those are things like greenhouse gas reduction, efficiency, protection of the environment, enhancement of biodiversity and sustainability, as I've said. And to the extent that this happens outside of the UK, that's obviously a bonus. But we are a UK geographically focused entity, so we focus specifically initially on the outcomes, the green outcomes, which have a relevance directly and substantially in the UK. So we have market standards for evaluation, and where those evaluation criteria don't exist, we create our own. And we have a set of minimum standards and green attributes that a project must meet before we look at investing into it. So what have we done thus far? Thus far, we have invested in a number of transactions, both from a fund-to-fund point of view. So we've invested in a number of underlying funds in the energy efficiency sphere. Those are SDCL and Equitix that you'll see the third and the fourth on that slide. There is Foresight and Greensphere, which are waste and biomass funds, and Greensphere has just announced a transaction over the weekend. Very pleased that we were involved in closing of that. SDCL and Equitix a couple of months ago announced their first transactions, and those transactions were in the area of a building retrofit and a very innovative structure that SDCL used, and the biomass boiler reconstruction, which was done by Equitix in a whiskey distillery in Scotland. Then we've invested a large amount of funding into a waste biomass conversion, and that is pure power generation going to the grid, and that is with Drax. On the offshore wind side, we were responsible for co-funding alongside Greencoat the refinancing of the Warney Flats platform. And then on the waste and the biomass side, transactions there, Wakefield and Gloucester, And on the NDEE side, we also, on the back of a large transaction, probably the largest transaction they've seen in energy efficiency in the NHS, the Addenbrooke's Hospital in Cambridgeshire Foundation, Energy's Foundation Trust, and that was the funding of a CHP unit with a whole lot of other ancillary energy efficiency bits and bobs added to that, and also a fairly sizable, innovative, and market-leading transaction structure in the NHS. And that particular investment was managed and introduced by Aviva, who now run a fund specifically focused on energy centres within the NHS. Then lastly, we applied some funding or committed funding to funding of the structure that lends in terms of the Green Deal. So our GHG emissions reduction thus far, we estimate that we have made a difference from a reduction point of view of 43 megatons of CO2 abated over the lifetime of the portfolio that we have invested thus far. And that is equal to the annual carbon footprint of Scotland, so a fairly substantial amount to date. In terms of renewable power generation, we expect to be contributing 12 terawatt hours of renewable power to UK's renewable energy 20. And that's just under 10% of the projected renewable electricity generation required by that time. Waste to landfill avoided, which is the third area we focus on, estimated 326,000 tonnes of waste to landfill avoided in the portfolio by 2020, and annual waste of around 300,000 tonnes. So those are fairly substantial, chunky deals we've done since inception, and we've only been operating with security of funding since November of last year, so we've been very, very active in the market. We've worked with private capital in a number of areas. Some of the names you'll recognize there, some not. You've got the large wood biomass suppliers, names like Stobart, large energy development and management companies, Dong Energy, large financial institutions, Barclays, Santander, and then smaller ESCOs and the likes of Carillion, and even the more racy financiers in the structured finance and project finance area. So we work with a number of funds, fund management, standard financial lending institutions, and then international institutions as well, like Masdar. So we had to look at the drivers of energy efficiency, and this is my sector. And now we're going to dive into a little bit of the detail of the challenges in the energy efficiency market in the UK. So when you look at drivers of the energy efficiency market, we obviously focused from a portfolio point of view on the services and industry sector, which is about a third of the energy consumption market in the UK. Transport and domestic are currently outside of our remit. So we focus on the services and industry. Now, if you look, it's difficult to see at this level of detail, but what you will notice there, of that 523 terawatt hours, the market is incredibly fragmented. So the drivers here, firstly, target reduction of 20% by 2020. You have expectation on a real basis of substantial increases in energy prices. You've got technology development in certain areas, which has come of age in renewable heat, LED lighting, starting to become incredibly price competitive and low maintenance over a period of time. And then from an industrial competitiveness point of view, given energy usage in some of the energy intensive industries is such a large portion of the revenue spend, that this has become an issue which is unrelated necessarily to sustainability, but it just makes commercial sense. So again, looking at that market, when we break that market down into the areas that we want to operate in, we focus on a number of technology clusters. So where we see discrete opportunities in the market, they're along these technology clusters, which can be broken down as follows. Building retrofit, which looks at the retrofitting and installation of energy efficient lighting, energy efficient air conditioning, insulation, glazing, and then power generation on site or heating on site, which heating and chilling on site, which are the boiler and chiller type upgrades. So those markets generally are tacked onto other larger energy efficiency projects. So where you have a renewable heat or a CHP, a power generation and district heating scheme, often those schemes are alongside a number of building retrofit installations. Then the three areas which are very discrete: industrial processes, smart meters, and outdoor lighting. Outdoor lighting is obviously discrete because it focuses just on replacement of old incandescent bulbs with LED street lighting to reduce energy consumption by a factor of a half, in some cases two-thirds. That's a very discrete area, and that's largely a public sector area and done through local authorities. The smart meters is a new initiative, and both on the smart meters and communication hubs, which are the communication devices which talk to the central database, which manages and reports on the information. Again, a discrete area. And then lastly, industrial processes, and that's where you have large industrial processes which, through innovation or through just technological and process change, energy usage can be substantially reduced. Typical ones there, which are cross-industry, are things like variable speed drives, motors and pumps, and waste heat recovery. And then there are things which are specific to certain industries, like furnace replacement, on-site power generation, and so forth. So if we organize it in terms of our focuses, and you split it between public sector, industrials, and CHP, and smart grid and metering, which is very discrete, we have a particular view on the public sector and why there are challenges in the public sector. And if you're not involved in the energy efficiency market, you wouldn't know that the only real progress at scale has been made in the health sector and the public sector. The next wave, we believe, will be a combination of large-scale retrofitting and power generation and heat offtake CHP on-site in the NHS, alongside large implementation of street lighting. And there are strong policy drivers there. We have, unfortunately, a lack of development capacity. So generally, either through austerity drives or simply because there's so many other programs from an infrastructure point of view that a local authority has to look at, these often don't happen at the speed that a commercial lender would like. The advantage there you have, though, is that you have huge replication potential. So if you do a particular deal in the NHS and cost it a certain way and structure it from a legal point of view in a certain way, it's easy to replicate. Similarly, within the PFI market and outside of the PFI direct contracting market in street lighting, those are easy types of things to replicate because the technology is fairly simple and the implementation is similar. So industrials and CHP, combined heat and power, again, is relevant for on-site power generation in the industrial context. There's strong financial and policy drivers there again. There's a requirement, climate change levy, climate change agreement. There are cost requirements in energy-intensive industries to reduce energy costs. But the difficulty there you have is marrying the decisions made at executive level and those made at an installation level. And then lastly, on the smart grid and metering, huge investment required there. The business case is very strong and has been demonstrated in other countries where there has been a smart grid implementation and energy usage and demand has substantially reduced. And it is going to be a fundamental component of the future energy system, partly from a technology upgrade and partly from a demand reduction point of view. So if we had to look at the total market for energy efficiency, and we have to do this because we've got to determine where are we going to spend our money and where do we need to spend our time developing different parts of the market. So if you look at this slide, and the easiest way to see it is between the two colors of blue and red, and these are estimates in total of the financing requirements and our estimates in the market of where the GIB needs to help with funding. So where there's internal financing, where the host, and in some cases that'll be a local authority, in other cases that'll be a company, in other cases that'll be the NHS Trust. That is where the host has the finance available or wishes to finance it themselves. And then external financing is where we see a need for external financing through people like the GIB or other commercial lenders or investors. So in the building retrofit market, due to the nature of the market and the majority of current building retrofit done through the normal refurb or replacement cycle, and because this all depends on when the length of the leases are on particular buildings and generally differs from building to building and can't be done on a portfolio basis, we believe that the external financing opportunity there is fairly low, despite there being a big requirement of a total of 1.6 billion to be spent in that area. We don't believe on a purely commercial building basis that those opportunities are that great. So we see a small portion of the market being able to be funded by third parties. Renewable heat, again, thus far our expectation has been, generally because of the payback periods of these, that the renewable heat is going to be predominantly internally financed, and part of that is because the companies receiving the renewable heat incentive will want to have security over that 20-year renewable heat incentive scheme. Then on the CHP side, we found, especially in the health sector, that there is a requirement for external financing, and to a large extent, that is assisting the contractors in those projects asset finance the CHP kit or the boiler kit or the other ancillary energy efficiency reduction technology. So we believe that's a substantial part of the market. Outdoor lighting, obviously the local authorities, a large portion of the local authorities in the UK are in very good shape. They would be highly rated if they were credit rated, and they have borrowing ability through the Public Works Loan Board, which is a prudential borrowing through the Debt Management Office of HMT, the Treasury, effectively. And we see a small opportunity there, but in the time between this presentation and research being done and the actual work we've done out in the market, we probably believe that that'll shift up over time, and possibly because the Public Works Loan Board rates are going to increase as the lending rates increase in the market. So we might see that 20% might shift up a little bit, but we do believe for local authorities that the technology has come of age and that the ability to fund those will increase. However, the contracting structures in street lighting are complicated. Some of them are in these public-private partnerships called PFIs, which are difficult to unpick because you often have a set relationship and funding relationship between external funders and the council. And in other cases, the contracting process in the public arena, given our rules around procurement, are quite difficult and lengthy. Industrial processes, again, very difficult market to assess because some of the big chunkier projects are in the areas where the credit quality of the counterparties are not that good, and in other cases they're very small projects. So our best estimate is about half of this market will be need external financing. However, in the third area, the smart meters area, we believe that there's going to be a large requirement for external financing. We found on the first bit of the communication hubs that that's not in fact the case on the communication devices, but we believe for the smart meters themselves that there'll be a big financing requirement, and the total ticket size there of 2 billion. So if we look at that in aggregate and in total, we're looking at approximately half the market of 9.4 billion requiring external finance. So again, sorry for all the words on the slide. This is difficult to read, but I'll give you a very, very brief snapshot of what we see as the issues. Obviously, the main issue that we can solve is capital provision and flexibility of capital provision in terms of the way we structure it. We can go out to much longer term than most commercial institutions can go, even though we're investing on commercial rates. So there is currently a lack of long-term financing. So you'll find that the quicker payback projects generally get done, and by quicker payback, I mean 1 to 3 years. The ones outside of that period, other than the ones in the public sector, generally don't happen if they're in an industrial host. So we have the ability then to provide external financing, which might meet the requirements of a third-party financier, an industrial host, for example, and doesn't compromise their balance sheet. The GIB approach then on the provision of information, the costs and risks, the skill mix and executive attention is really focused on developing the market and bringing this up the agenda. Now, that's not easy to do, never mind at a policy level or at a market level, but actually on an on-project level. It requires some very careful consideration of the market you're operating in and what the requirement is there. So we need to consider the structures of the contract. We need to focus on larger portfolios of projects so that we can drive some sort of aggregation. And this has meets two requirements. One, if you're applying a lot of resources to a number of small projects, you're spending too much money in the investments and they aren't commercial. But the other thing is, if you can have headline projects, it's easier from a demonstration point of view to bring the rest of the market in line with the energy efficiency larger energy efficiency projects that you've already funded. So in the costs and risks, we're looking at developing methodologies which are more robust to record savings, and in so make sure that energy performance contracts, which haven't been that successful in the UK but have been much more successful, specifically in the public sector in places like the US, are replicated here. In the public sector, on the skill mix side, that's something we can help with. Now, this is not that the public sector doesn't have skills, it's often that those skills are thin on the ground, and they generally are the skills that are required or fulfilled by a developer in a private sector arena, but you don't have development resources necessarily in the public sector. So, development of a business case, making it investable, developing of the financial models, and really just pushing the process through local authorities, the health sector, and central government is something that where we can embed resources in projects to do so and provide contingent funding, we will do that. And then executive attention, there are a whole lot of initiatives that we're looking at the moment, which are programs to run competitions to raise the profile of energy efficiency, to leverage our relationship in government to make sure that it's also well represented and up on the policy and public stage. Then driving the green reporting requirements and being very involved in development of standards for that. And then focusing on existing assets and pipeline where possible. So we don't want to do very, very early stage origination of projects. Like, I'm not going to spend too much time on this, but there are significant barriers to energy efficiency investment, and the energy efficiency investment has been small to very small in the recent history in the UK. For example, in the last year, a recent Bloomberg New Energy Finance alongside Eve reported that in the SME sector, the total investment spend committed, and that's not even deployed, that's committed in the UK market right across the economy in that sector was in the region of £80 million. And that's peanuts as to what our targets are for deployment over the next few years. Now, that doesn't include the FTSE 100 companies, but has quite a large spread of companies included in that. So there's obviously work to do. So fragmentation is the biggest issue. Often these energy efficiency projects are just very small, and you need to find a way of aggregating them. Deal size talks to that as well. In the cases where you've got very large sectors and there's some concentration in the industry, like in the steel industry, for example, or the chemicals industry, where you've got a number of large players as opposed to other industries where you've got the top energy users are only, let's say, 5% of the total market in these other sectors. You might have 5 or 6 players in these larger energy intensive sectors dominating energy usage. But those are the sectors that are suffering the downturn, and from a lending point of view have credit risks, so they're difficult to lend to. So we've also got to be very flexible in the way we approach those and find out ways of making sure that those projects are investable. Then tenor, that's talking about the length that you invest into a project, or length of time you invest into a project. We obviously can fulfill that requirement. Accounting treatment is something that's changing and probably going to take another hour to discuss this. But as it stands right now, you have 2 types of lease arrangements, one which is effectively off balance sheet and one which is on balance sheet. The future rules are going to bring those all back onto balance sheet. And there's a very small or minor concession in terms of a service arrangement, which will be fully on balance sheet, fully off balance sheet, which will in some cases in energy provision be robust, but in a large number of cases, from an accounting point of view, from 2017 onwards, all of these types of energy performance contracting arrangements are going to end up on balance sheet. And that's a challenge, because when you're wanting to do external financing, some of the hosts don't want to increase their lending or don't want to change their balance sheet status. And the last point to make here, I think, is that there is currently no secondary market for energy efficiency investments. You can't bundle up a whole lot of energy efficiency investments and then list them recycle that capital so that you can use it again for other projects. There isn't yet a model to do that. Now we are looking at possible structures to do that, but right now as it stands, that hasn't been done effectively. So to go into a little bit of detail about our partner funds, they're the three funds of Equitix, SDCL, and Aviva. Equitix is a specialist infrastructure investor, and they generally work in partnership with local authorities and corporate pension funds. They do generically socially responsible investment, sustainable investment, and they have an energy savings investment fund, which is 50 million funded by the GIB, and they are sourcing the matched funding for that. And being a cornerstone investor, they were one of the two funds that impressed us in the bid process, and they are investing in the smaller projects that the GIB finds too small to invest in, but are an important part of the market. So they did a 49% investment in Tomatin Distillery, which was a biomass boiler. They are looking at a number of other biomass boiler funding projects, and again, we believe they'll be very successful as that they've been successful in that niche before. SDCL, they're a specialist advisory firm that had deep expertise in the energy efficiency market, and their first deal that they did was the retrofit and delivered by Johnson Controls of the facilities, industrial facilities owned by the Kingspan Group. And again, a very innovative structure based on the realization of savings, contracted realization of savings. Aviva, we've talked about a little bit. Again, this 50 million fund committed, 50 million at least committed by the GIB, and a further 50 will be committed by other partners. The first investment there, and this is the fund was effectively created on the back of this investment, was the Cambridge University Hospitals NHS Foundation Trust, the Addenbrooke's Hospital, for boilers, heat recovery, and a number of ancillary building retrofit type installations. So very active, and to the extent that we have projects which are too small for the GIB to look at directly, we pass on a whole host of opportunities to these funds and are expecting them to be very successful in the short term in aggregating those smaller projects. So what is our value as a partner? We feel that we are unique in a number of areas. We've got a very knowledgeable team, and by that I don't mean we are highly intelligent in our particular market sectors. I mean that we've got quite a diverse diverse types and histories and experiences in the market. So we have people who've worked in private equity funds, who've worked for long-term lenders, senior debt. We've worked in public and private project finance. We have policy advisors. We've got our own technical advisors in combustion and wind and CHP. So a wide range of skills, and all of the transactions that we do are done by the same team. So it's very unique in a financial institution to have all those skills applied to a set of different financial circumstances, and we believe that makes us unique and makes us much more flexible in the term that, in respect of a particular project that has an intractable financing solution. Then size and flexible capital commitment. We obviously can invest across the capital structure and across a length of terms. So we can invest in the very short term, 1 to 3 years. We can invest right up to 25 years, and that doesn't restrict our ability to invest. We're obviously very aggressive in the sense that we want to deploy capital. We want to address the market failure. We want to be successful in the market in demonstrating that you can be green and make a commercial return. And we have an amount of money to deploy by March 2016, which is a substantial amount of money. And we are looking to deploy that commercially in that time. So we have very supportive senior management, and we are constantly being pushed to find deals, find good deals, and make sure they're transacted and executed quickly. Again, we have a unique market position. We're funded by government, but we are commercial, so we have relationships within the financial institutional market. We have relationships across the energy market, but we're also well supported by government, and we're very close to policy development, and to the extent that we need constant updates or are embedded in certain processes where we can advise government on what we're seeing in the market and what the market failures are from an incentive point of view, we try and do that. So if you were to come to us with a transaction, you obviously need to know what are we going to do, how long are we going to take, how do we look at a transaction, and what the timeline is associated with that. So generally we collect initial amount of information over a period of 2 to 3 weeks. We sign a non-disclosure agreement. We look at information memorandum or whatever collated information is given to us, and we have a Q&A session with the developers or the hosts. And generally, the information required at that stage is as much information as the host can provide, but it must at least demonstrate that it meets our green hurdle and is an investable proposition. Then if we make the decision and we go through the process of our initial review, and that includes an investment committee review to get it over the hurdle of us spending time and resources and looking at it, we get into a detailed due diligence and document negotiation. And that generally can take around 2 months. So there we look at detailed technical issues, we look at the legal environment, we look at the environmental consequences of this investment, both at a headline level and in detail at the project level. And then we financially evaluate what we think our commercial return would be. And that's a process of ongoing negotiation and restructuring and so forth with a host or with a counterparty. Then once we've made an investment decision, there's always a process for finalizing legal documentation and executing and transacting that. And that investment decision and deal closing process would take us typically another month or so. And then from then on, once you've made the investment, we obviously manage that process directly, and it goes onto our books, and we have a portfolio management section in the bank which runs that process for us and reports on that on a periodic basis. So a good case study, I suppose, of the type of thing that the energy efficiency team would look at. In this case, we're just looking at the one the fund did, but this is probably a good example. Just to give you a sense of how we look at a project and what the types of returns that we want to get out of it are. The Realm Energy Centre is the Addenbrooke's Hospital, and that's the energy centre which provides heat and power to that NHS Foundation Trust and that particular site. So we committed 50 million, as I said, to the Aviva Investors Realm Energy Centres Fund. Of that, 16 million was used to fund this particular transaction. Sorry, 18 million was used of a total of 36. The expected savings are 25,000 tonnes per annum, and we expect this over the term operation of the project, which is effectively the way we calculate that is we look at the lifetime of the technology. We expect a 25-year operation of the project to deliver a reduction in energy bills of over £20 million. And this obviously will help reach the 2020 carbon reduction goals of the Trust, and also contribute in a small way to the 2020 targets of the UK government. So what we felt we did there is, in assisting Aviva in evaluating, working through the due diligence and ultimately funding this project, we were able to crowd in or bring in other funders for the remaining 18 million. And that we see as a success. One, we've addressed a market failure. Two, we've been additional. And three, we've done it on commercial terms. So we expect to mobilize at least another 50 million of capital against the 50 million that we've spent in the fund, in the Aviva fund. And it's the same for all the funds that we invest in, both in the energy efficiency sector and in the waste sector. So within the energy efficiency grouping, you'll see my pretty mug there on the top left. We have a very skilled team, which is soon going to have the addition of another highly skilled renewable energy resource. I manage the section, the sector, and we have people who have got public-private partnership experience, deep experience within the public sector and in the investment banking. That would be Charles Abel-Smith, Ian Watson, who comes from a project financing background, Malcolm Ball, both in government policy development, and he is and was working with Arup in industry, so knows a lot about the installation and management of the types of things that we're investing in. Miles Alexander, who comes from an M&A background with a large steel company, and then a number of other high-level resources who have experience in energy and infrastructure, leveraged finance, M&A in the energy sector, both public government and public policy, and then finally renewables project finance. And then Bill Rogers, who assists me managing the team, who has deep renewables and very deep energy expertise, energy efficiency expertise. So we believe we've got the strongest group. We believe this is the biggest energy efficiency focused investment banking team in the UK and as far as we know in Europe. And so we are very pleased that we are going to be a force in the energy efficiency investment market in the next 2 to 3 years. And to the extent that you need to contact us in any manner, please feel free to email any of the team on those email addresses you see there, or phone us directly if you think you've got an investment proposition or you just want to see our views on a particular type of investment or particular market segment. And that's it from me.
Thank you very much, Gregor. While we are waiting for questions, I have prepared a few questions and maybe to initiate some discussion. What would you say would be the minimal amount or value of a project that could be considered? Because you mentioned that there are usually some smaller projects that should be aggregated. So what would be the minimum value of proposed projects?
Well, there are two answers to that. One answer is what the bank would look at directly, and the other answer is what the underlying funds would look at. So the underlying funds would look at projects where they can invest half of a total capital value of £1 million for any one investment, and in some cases a little bit less. The bank obviously looks at much bigger projects or much bigger portfolios of projects. So we would generally be working with the bigger NHS trusts. We would be working with the larger industrial hosts, and we'd be working, with the big energy infrastructure projects or energy reduction infrastructure projects within local authorities. So I think if there are much smaller projects than that, there are other financing solutions out there, and there are a number of government funds which support those sorts of things. But if they were very small projects, it wouldn't make sense for us to spend a large amount of time and resources on them. It would be best to go to some of those acceleration funds that are out there and available from government.
Okay, I suppose that you now see the first question on your screen from John Cape. If you don't, I can read it. Can you recap? You do. Do you see the first question?
Yeah. Can you recap the reference to the contingent funding to support development? Okay, in the case, and I'll take a local authority because this is specifically where we're looking to apply it. In the case where there is a robust case for energy reduction, and I'll use the example, let's say, of a street lighting deal, but the investment proposition and the surveys have not been completed in order for us to assess the size and the scale of the project and whether it includes things like lighting or it includes the column and other infrastructure around it. We would be willing to lend or provide a developmental loan to that local authority contingent on us being providing the funding for the ultimate project. So the deal ultimately would work that we would lend the money to the local authority to develop it and to apply resources to get the project to investable stage. Once that's been done, they make the decision to go ahead with the project or not. In the case they make the decision not to go ahead with the project, then they would pay that money back. In the case that it would go ahead, it would be rolled up into the total lending proposition we would give to the to the local authority.
There is also the second question. Can you see it? Also from John
can you
Cape?
fund a program as distinct from a project?
Yes.
We can fund a program to the extent that it is an aggregated portfolio of projects that have an investment return, but we are not allowed to support programs that have no investment return or are specifically development and have no result of either the funds being returned or the funds actually generating an investment return. So our state aid approval doesn't allow us to donate funds to support a program which is just, let's say, an outreach program or something for the development of the market per se.
Okay. Well, I have a few more questions while we are waiting for our viewers to ask questions. Do applicants need maybe some help in preparing a good business case. Does GIB provide some assistance, guidelines of if you see some business cases that are not strong enough?
So I think that the question you're asking is, would we provide resources to assist with a business case development?
Or training or guidelines?
We can provide examples of what we'd expect, which is generally a due diligence type questionnaire. But we wouldn't provide assistance in developing detailed business cases because, again, we're not allowed to do that unless it's on the loan basis. And the reason we do that is because it fits within our mandate, but also in the case where people just want you to help them developing business cases and you don't know whether it's a commercial project or not, you need to have the counterparty sufficiently committed to progressing with that project.
There is one more question, if you can see it on the screen, from Neil Turley.
Yeah, I'll read that out. SMEs involved as an ESCO would probably be involved in a lot of small projects. Would it be possible to generate a fund to finance a number of projects with the Green Bank providing a proportion of the funding? If so, what would be the approximate percentage of funding? So there are a number of answers to this. Generally, we would look at a portfolio of projects as a discrete investment in itself. So if we were looking at, let's say, a number of ground source heat pumps at 50 installations around the country, that could be looked at as a single facility because you're funding a single technology and the structure would be the same. In that case, we wouldn't develop a fund. In the case that you're looking at a whole lot of diverse investments, those would generally be channeled in any event through our fund. There's one caveat to that, and in the case that we have a developer who has got a track record of developing a large number of energy efficiency projects, we might, in theory, allocate funding to the development of those and give some sort of comfort to the ESCO that there would be funding available if they are substantially of the form of the ones they've previously done. Now, that wouldn't be a fund in itself, and it would be no legal commitment, but it would be a commitment to carry on the relationship with that entity. And generally, to answer the second part of the question, we would look to that entity or third party to match our funding on a 50-50 basis.
There is one more question from John Cape. I hope you can see it as well.
Yes, I'll just expand that. Could you fund CHP in relation to new build developments, mixed housing only? If I'm understanding that correctly, we can fund new build CHP, but we can't fund the property element of the investment. So if the investment included investing in bricks and mortar and the CHP was a component of that, we wouldn't be able to invest in it. We would only be able to invest in the energy efficiency component of that investment.
Okay. Have you had any examples of aggregated smaller projects?
We've got a lot of examples, obviously confidentially. There are under confidentiality agreements currently that we can't talk about. So within the sectors, and I can name the sectors, there are sectors where there are aggregations of projects, and that is in things like the FMCG and retail sectors. So those projects are out there, and there are projects where we look at a number of local authorities who form part of a greater authority or a greater agreement to pool projects. And those are generally in the building retrofit, and those are generally in the public sector. So we are seeing those aggregated projects. But again, they take a long time to aggregate, and you need firm commitment from all the people who host those projects to agree as to how they aggregate them and that they would be funded centrally.
Yes, that would be interesting really to know who initiates aggregation. Do you advise them when they come to you with a small project, and then how the whole process is organized? That's what I think is probably takes time and is a bit complicated.
Yeah, generally in our experience, what's happened, or since I've been at the GIB, is we interact with a host or a local authority who has some ideas and has conceived the possibility of aggregating but hasn't done it on a formal basis. And we can then provide the structure simply by being there and showing how we intend to fund these sorts of things, which will add impetus to formally aggregate a number of projects. So that, I mean, we're successful in our role of doing that, and that's, I suppose, part of the process of accelerating investment is that we're accelerating aggregation by a third party.
Okay. There is a small addition to John Cape's question. If you see that also related, well, he clarifies that it is related to housing only new development. I think it's related to his previous question.
If I'm understanding that correctly, you're asking me, can we fund the CHP component of a new housing development? And that would definitely be yes. Depends on the size, whether it fit into our remit or one of the funds.
Yeah, that was the question. Since our project is about integration of different types of low carbon infrastructure, could you say if GIB encourages, supports these types of projects? Well, just to explain a little bit more, for example, we support projects that look into renewable energy, let's say photovoltaics on buildings, but also how now that energy produced from photovoltaics could be used for low carbon transport, how we integrate different types of low carbon technologies, or even looking into waste, into power, reduction of water usage and reuse of water. So, and let's say information communication technologies that could be used to monitor and report on energy generation or usage. Have you had any examples, and what would be your views on these types of projects?
Well, the first answer is to answer what we're allowed to do and where we got our state aid approval. So we didn't get our state aid approval for things like solar and small scale renewables because there was a belief at the time that there wasn't a market failure that needed to be addressed. So in theory, in terms of the bank's philosophy, we would have invested in those areas if that generated a reduction in emissions or generated a positive social or green impact. But currently, we're restricted from doing that. So there's particular examples. No, we don't. But in general, we would support the development of low carbon infrastructure to the extent that we can. Now, we might find that the market conditions change. So we might find that there is a failure in small scale renewables or there is a deemed failure, in which case we can apply to Brussels, and if we are successful, it extends our remit, and so we can invest in those areas. But as it stands, we are not permitted to do so. We can only invest in those sectors that I mentioned at the beginning of the presentation, which are our priority and non-priority sectors.
As I noticed that there were not any larger projects in Scotland. Am I right in that?
Currently, no, but we're very soon hoping to change that. So watch the space, and I'm pretty confident in the next 12 months will have a more forceful presence in the Scottish economy as far as both energy efficiency and our other activities are concerned.
Do you think that some organizations like Convention of Scottish Local Authorities are aware enough of the opportunities that, well, the funding that they can obtain from a Green Investment Bank?
We're finding that we don't think so, and so our initial approach to the market is working with a couple of what we're calling pathfinder authorities who are more forward thinking and have made strides in these areas, and generally they're bigger authorities in Scotland and in the UK. But there will come a time in the next 2 or 3 months where we will be approaching the types of organizations you talk about, both at the local authority level and at the treasurer level of local authorities, to be more direct as to what our market offerings are going to be.
Perhaps Scottish Property Federation would be then of interest, or Scottish Federation of Housing Associations in relation.
Yeah, those are exactly the sorts of organizations that we are planning to or have started speaking to.
For the moment, we do not have any additional questions from our online online viewers. Would you like to add anything or to conclude or to tell us maybe about some future plans, anything that you would like to say in conclusion?
Yeah, one thing I think I can say, I've probably been very positive about the ability for us to make a difference in the market and us to invest funds. But the reality on the ground is the Green Investment Bank has been set up to address areas where there's market failure. And these are not easy areas to invest in. And energy efficiency of all the areas is the most difficult, the most intractable, and probably the longest from beginning of initiation of contact with a particular host company or local authority through to concluding a transaction. The transactions in reality are much smaller. So it's not an easy market. It's very, very challenging. So to the extent that there's anyone out there who wants to support us, help us bang the drum and bring us projects, we'd much appreciate that. And to the extent that people want to interact with us and we can pass them on to the right funding solution, whether it's us or the funds, also very happy to do that. So we're a fairly open organization. We'd like to keep out there, and to the extent that that this sort of exercise helps, we'd like to do more of it.
Here is one more question from Linda Forbes. I hope you see it on your screen now.
Yes. Okay, there's a question. Can you fund grid infrastructure to support delivery of renewable projects, or is this excluded from your remit? I was thinking of active network management, additional cabling, and so forth. So currently that is outside of our remit, right to the large interconnector type investments through to the smaller investments. Currently on the energy efficiency, the only caveat to that is that the actual kit that sits inside a household, which records it and communicates it, the smart meters and the communication hubs are allowed. But currently we are not allowed to invest in the grid itself. Now, again, that's one of those areas where we might see a market failure in the near future, and we will go back to Brussels to extend our remit. But as it stands right now, we can't.
Here is one more question from Richard Michaeljohn.
Let's have a look.
Do you see that question?
Yeah, the obvious answer to that is speak to our funds, SDCL or Equitix, or in this case that it's in the health sector, Viva. And the other port of call is obviously to speak to the contractors who like to guarantee these sorts of savings for buildings and do the retrofit themselves. So there are numbers of players out there in the market. We interact with a whole number of them, but it's very easy to find them on the net, do a little bit of research. It's a fairly active market.
Okay. Well, if there are no questions, any more questions, and I don't see any coming, I think we can conclude our webinar now. I would first of all like to thank you very much for your presentation. We will provide a video recording of this webinar and also your slides on our website. So thanks once again, but before we leave, I would just like to address again our online viewers and to alert about forthcoming webinars and events that we are organizing. The next one is tomorrow, and it is a webinar organized in collaboration with Local Energy Scotland about Scottish Government Community and Renewable Energy Scheme, or CARES. After that, we have a webinar on 9th of October, where we will have speakers from Community Energy Scotland speaking about local energy economies, or integrating low carbon infrastructure and maximizing the benefits to local communities. Then on 29th of October, we will have a live event which is organized in collaboration with Scotland Europa about Horizon 2020, about forthcoming European funding, understanding the opportunities for Scotland, specifically related to construction. And finally, on the 7th of November, we have a whole day event entitled Localized Energy Generation and Distribution, Funding, Research and Practices, where we will have speakers from Technology Strategy Board, from CARES, from CES, or Community Energy Scotland, and researchers of several universities involved in our project. So I would like now to thank all our online viewers for watching this webinar, and I hope to speak to them tomorrow again. And thank you very much.